Hello, Jamie. How you going?
Good. How are you?
Not too bad. Not too bad.
Good,
Ready to
good.
roll again?
Yeah, we have similar signups compared to the last one, so it'll be interesting to see how many sign in today.
What changes there are or not? There are some.
Yeah. So your slides are the same?
Pretty much so.
Okay. I guess I'm not sharing screen, so I can click around here and play around. How did the delegation dinner go?
Interesting times. Interesting times.
Oh yeah? Can't wait to hear you share a bit more about those stories. Are you going to share about it tonight?
No, no.
Oh,
Uh,
pity.
we have a port that is managed by Chinese interests. Um, so there are some interesting
Do you say
developments
a
around
pot?
that.
Do you say a pot? P-O-R-T?
Yeah, PRT. Yeah. Shipping port. Yeah.
Oh, okay. Wow. You have a take on the CK Hutchison pot sale? You reckon it's going to go through?
Oh yeah. It's a difficult question, Jamie. It's a difficult question.
No,
Um,
just a friendly chat. We're not going to share it with anyone else.
I realise that. I realise that. Um, just exactly what Trump is capable of doing, and someone is almost beyond imagination. His latest proposal today is to uh, impose a use his rhetoric, $1 million on port fees for every Chinese
Mm,
ship that comes to the US.
yeah.
Um, it won't be
Hey,
$1 million,
Jamie,
something like that.
Jamie, and
Hi, Sri.
Daryl. Just a heads up. The we have the room is open. We have attendees coming in right now. So if there's anything that's embargo, it should stay embargo. It should, if it's not ready for official release, we should keep it that way. All right. So just
Oh,
a
okay,
heads up.
sorry. So it's
No
everyone
worries.
listening
Everyone's
in.
probably very excited to be tuning into what we are sharing right now. But this is not the official content, guys. The official content officially kicks off at 7 p.m. All right, so just stay tuned for 2 minutes and we'll kick things off proper.
Okay.
All right, we have some members of the audience in the room. While you guys are here, and I thank you for coming in early. If you can hear me loud and clear, just let me know in the chat box or question box. All right, Daryl can hear me. Lovely, great. And members of the audience, if from your side, if you can hear me clearly as well, just let me know. Just go to the top right hand corner of your screen. There should be a question box there. Just click on it and type yes if you can hear me loud and clear. We'll be starting in about 1 minute. Okay, all right, it's 7 o'clock right now. Let's kick things off. All right, welcome to another live webinar. We have a wonderful set of presenters today. We have Mr. Chartman himself, Mr. Daryl Guppy, and we have Jamie Chung, who is head of Macquarie Warrants Singapore. All right, first up, Mr. Daryl Guppy. He's the founder and CEO of GuppyTraders. Daryl Guppy has provided trading and investment analysis of financial markets for more than 30 years, 3 decades of experience, and he trades his own capital. Guppy provides strategic market analysis for CNBC Asia Squawkbox, where he's known as the Chartman. And along Mr. Guppy, we have head of Macquarie Warrants Singapore, Chung, and she will be sharing with us how we can use warrants to exercise the outlook that we will be hearing from Mr. Guppy. Okay, she's been educating investors on leveraging warrants to enhance their portfolio returns while being mindful of potential pitfalls. So you get a very balanced view of this product from Jamie later. And she'll be providing a warrant selection demonstration and answer any warrant queries that you may have on the product. If you've been keen to learn more about this product, this is a great opportunity for you to take the opportunity to ask questions. All right, Daryl, I'm going to give you sharing rights right now. I believe that you have a set of disclaimers that you want us to have a look at.
Okay, let me just get this adjusted. Sharing that, and that should give us a full screen. Oops, a daisy. Okay, that gives you a full screen.
Yeah, we have the full screen here. Daryl, if you're all set to go, I can hand the time over to you now, Daryl. Please take it away.
Okay, thank you very much, and thank you for attending this event this evening. As you're aware, I'm talking about analysis, about views of how the market is behaving. And as you can gather, the market is not behaving quite the way that it used to. There are some significant changes that are taking place, and at times it seems that the whole thing is overwhelming. So what I want to talk about tonight is my perspectives on the market and how that allows me to position myself to trade a variety of markets. We have to remember that uncommon profits do not come from common thinking. Now, it doesn't mean you need to be contrarian, bullish when others are bearish or bearish when others are bullish. It does mean that you need to look behind the headlines. There are times when it's profitable to join the crowd. There are times when it's profitable to go against the crowd. My purpose tonight is to challenge your thinking about current issues that are impacting markets so you can make a more informed decision in your choice of trading and investment opportunities. I'm not asking you to agree with my analysis, but I am asking you to stretch your thinking. Remember, just a few weeks ago, it was impossible to think that America would walk away from its support for Ukraine. Tonight, we start with what's driving US policy, then consider its impact on China and how this plays out in the Hong Kong market, because that's where the trading opportunities lie. You will have questions. Please note them down and we'll answer those as we go on. Trump is undermining global trade with tariffs, with sanctions, with all sorts of behaviours. Today, for instance, he's talking about imposing port fees on Chinese-owned ships. He says $1 million a visit. That's unrealistic. But probably there will be fees imposed on China ships, Costco shipping and others, China-manufactured ships that are calling into US ports. This disrupts markets. It kills some companies and offers opportunities for others. Now, it's important. I'm not concerned about whether this is right or wrong, whether we agree or disagree with Trump. What we need to understand is the impact of his decisions, and that starts with understanding why he might be taking this course of action. And it's only partially about making America great again. Resolving the debt burden of America is the primary driver for Trump. Elon Musk, who is apparently the de facto president of the United States, says, and I quote, we've got a $2 trillion deficit, and if we don't do something about this deficit, the country is going bankrupt. Trump knows something about how to handle bankruptcy. He's been there several times himself. Musk's comments suggest that the tariff wars are not primarily designed to make America great again, in the sense of bringing manufacturing back to the United States. Look, the scale and the speed of this type of industrial rebuild is measured in decades. It's too slow to achieve a solution to the insolvency that Musk has identified. Now, if we accept Musk's conclusions, then President Trump's obsession with tariffs, the most beautiful word in the dictionary, he says, may be more closely related to a solvency agenda. Now, if that's the case, it becomes useful to consider White House tariffs through this behavioural lens rather than through the lens of conventional statesmanship. The DOGE, the Department of Government Efficiency, is part of the solution for controlling expenditure, but the administration desperately needs other sources of income, and tariffs are part of the answer. If the real focus is on solvency, then what else does it imply for markets? First, it means there is no escape from tariffs. There's no compromise, no special deals, because it's not about favours for friends or compliance or punishment. It's a deliberate, desperate throw of the dice for a bankrupt nation which cannot repay its debts. We need to consider what that means for gold. We need to consider where support is likely to be found. What underpinned America's ability to develop this massive $1 trillion debt? It was the petrodollar that underpinned US sovereign risk and debt. It is the most valuable commodity in the world, and it could only be traded in US dollars up to October last year. It ended in October 2024. So what underpins the US dollar now? What gives us the confidence that the dollar is intact, that it can be traded, and that the foundations of the American economy are sound? We look to gold. Gold becomes the essential backstop to the dollar, if it is there. And that's the key question that even this week hasn't been answered. Many bullion dealers believe that the US gold reserves are much smaller than originally thought. They suggest that over the decades, the gold held in Fort Knox has been leased to bullion dealers who sold it into the gold market, thereby protecting the value of the dollar by holding down the gold price. Leasing the gold means the US can still claim to own the gold. A sale of gold has to be reported. Leases do not. Many people believe that gold might also have disappeared, in the sense that it's been used, even though it belongs to somebody else, because there are gold reserves there from Venezuela, from the UK, from European countries and others, that gold's been used to back their own financial or borrowing practices. Elon Musk, 2 weeks ago, announced a gold audit, and the holder of gold contracts, perhaps fearing the worst, are demanding settlement in gold delivery rather than in cash. The rise in the price of gold is driven by the increase in the physical purchases in the market. Now, we can't trade gold through our warrants, but we can trade gold through individual gold producers, some of which are covered by warrants. The important things that I want to emphasize here is that economic strength and sovereignty in the US was underpinned by the petrodollar. That's disappeared. Now we're looking to gold to underpin that, but we're not too sure exactly how much gold might or might not be there. Let's see how these factors are reflected in index activity in the S&P, because that's what we can trade. When we look at the chart of the S&P, the key factor is this developing rounding top. Now, if we take the depth of that rounding top and project it downwards, then our downside target is 5,200. It also means that the market can rally quite substantially up to 6,000, even slightly higher, and still remain consistent with this rounding top pattern. There are a number of brokers, both here and in the United States, who are forecasting a 20% retracement in the S&P. That's also supported by the chart analysis. 20% is just a little bit below 5,200, which is the rounding top target. So what's that mean? That means that we are still working in a bearish environment, and that any recovery, any rebound, is likely to be short-lived. So rather than entering in here in anticipation of a strong rally and development of a new uptrend, it's more likely to be a rally before the downtrend pressure continues. There is no question when we look at the NASDAQ that we're seeing a similar type of behavior. I'll just go back to S&P at this stage. S&P, we have a downside target of 5,200. With the NASDAQ, the important features are that we've broken below this resistance level or support level, and we've broken below the value of this long-term uptrend line. The downside target is 18,500. And again, we can see where we can have short-term rallies up to these resistance levels, but the general behavior of the market, the general pressure, is downward. We turn to gold. Gold has already achieved the 3,000 target that we set earlier, a week or two ago, and is well on the way towards moving towards the 3,200 target. These targets are calculated by taking the width of the trading band and projecting it upwards. Gold can retreat back to around 2,900, slightly lower, and still remain consistent with the long-term uptrend. Tariffs are shooting yourself in the foot. They are inflationary, and that lifts interest rates. The Fed has not dropped interest rates at the last meeting. Tariffs stifle the economy. It's not immediate stifling, but it is inevitable. So the question becomes, how does that impact on China? Because the impact on China will flow through to our own markets. We need to understand what's happening in China before we can understand what's happening with the Hang Seng. The US is tackling the second largest economy in the world. The China economy is healthy. In considering China's response to tariffs and sanctions, we also need to consider the state of the Chinese economy, its challenges and its responses. The two sessions, which concluded last week, added to our knowledge. The primary challenge for the Chinese economy is the middle income trap. And you overcome the middle income trap by increasing productivity. Productivity is increased by the expansion of the digital economy, and that's where China's focus is. Less than 14% of China's exports go to the United States, although it's unlikely to happen. If China stopped all their exports to the United States, the impact on Chinese growth is estimated to be around 1%. It's no longer a major factor. Exports are going elsewhere. Increases in productivity. Those of you who are a bit older like me will remember when you wanted to download a large file from the web, it says it may take 2 days and 13 hours and 46 minutes to complete. Now the development of 6G, AI, quantum mechanics, all the rest of it, increase the productivity of the economy. That's what's driving China. That's where President Xi's focus was in the Two Sessions meeting. Many people think that the impact on tariffs will be the same as it was in Japan in the 1980s. In 1985, Japan agreed to the Plaza Accords, under which the appreciation of the Japanese yen decimated its exports and investments. China is not going to allow that to happen. The Chinese response is to seek alternative markets. The Belt and Road, its engagement with the Global South, is part of that alternative market. It is using the same approach as the Japanese use, which is if our goods are going to become more expensive, if our cars are going to become more expensive, we'll load them up with lots and lots of features so they become even better value, even at the higher prices. And then, of course, there is the development, as we said a moment ago, of the digital economy that also spreads throughout the Belt and Road environment. So what we find is that the reliance on the US market becomes less and less, which means that the impact of tariffs on the Chinese economy also become smaller and smaller. The development and the growth that takes place, it takes place in what we used to call the Third World, what China is calling the Global South. The room for economic development in the United States and in Europe is relatively small. They are mature, developed economies. They think the growth around 3% is very fast. But when you go to the Global South, there are whole populations that are moving rapidly towards middle class, and coming with that are all the consumer demands that China is so adept at filling. China's response to American tariffs is like acupuncture. Acupuncture is designed to improve the flow around the body. By precise actions, China can respond to Trump's tariffs, doing little damage to itself and inflicting maximum damage on the United States. Their points of weakness are rare earths. That's one of the things that Trump wants out of the Ukraine. He wants all that rare earths if he can possibly get it. The same with Australia. China controls most of the rare earths in terms of its processing. 40% of the pharmaceuticals that go into the United States are produced in China. Advanced industrial processes, the software that's involved in that, the mechanisms that are involved in that, all come from China. So by manipulating these pain points, China can respond effectively to America's imposition of tariffs and of sanctions. China's economy is increasingly diversified. It is less dependent upon any single market, and certainly less dependent upon the United States market than it was, say, 10 years ago or 15 years ago. And then, of course, we have the advances that are taking place in terms of AI, in terms of quantum computing, in terms of biomechanics. All of these are areas highlighted by President Xi at the Two Sessions meeting last week. These are what Xi called, the new forces of production. We don't want to dismiss that as mere sloganeering. These are serious economic policies, and they change the competitive landscape. They make the Chinese economy less vulnerable to sanctions and to tariffs. They improve the Chinese domestic market and the Belt and Road markets as well. So, if the sanctions are not going to destroy the Chinese economy, then how can we trade that resilience? And to do that, we trade through Hong Kong. But it's important to remember that Hong Kong is at arm's length exposure to China. Hong Kong is not an exact proxy for China, because how we look at the co-listed stocks, Alibaba, Baidu, BYD, China Life, etc., is influenced by Western views of China. But we can still tap into these changes that are taking place in China, the resilience of China, using warrants over this listing of stocks there. So what's important is, in terms of Hong Kong, we've broken through the 23,000 level. Our upside target is just under 27,000. And that is established by measuring the width of the trading band and projecting that upwards. The trading band is created by this support level and this resistance level. Our upside target is 26,650. We can trade the Hang Seng for a consistent move towards that target. This is not a rally, it's a continuation of the trend, unlike the S&P and the NASDAQ. If you want to trade tech, and the tech index, as distinct from taking individual risk on the tech stocks, then the HS Tech Weekly has less room to move. It has already broken above 4,800, which was a long-term resistance level, and is moving towards the target of 6,400. It's not a rally, it's a trend continuation, but the trend is almost exhausted in the sense that once this 6,400 level is reached, we are likely to see consolidation. However, measuring this target using trade band analysis, we're not too sure exactly where to place the trade band. If we place the lower level down here, then this lifts the upside target to 6,800. How do we trade it in terms of a warrant? It means that we trade from here to the resistance level, watch the consolidation. If the breakout continues, then we have a new target of 6,800. Now, very briefly, I want to consider the impact of Trump's tariffs and Trump's response to global trade on individual stocks that are covered by warrants in Singapore. Because what Trump is doing is breaking the logistics chains. And the things we have to watch for is that if we have Singaporean products that include American components that are exported to China, then they can be stopped with sanctions. Where we have Singaporean products that include Chinese components designed for export to America, then they will face additional tariffs at the same level as if they were Chinese products. So when we're considering warrants over individual stocks in Singapore, we need to be aware of their exposure to China. So what's this likely to look like? What are the opportunities that are emerging from this environment? How you see the opportunities depends on your perspective. Some people here will see a set of ladies' legs, others will see a set of gentlemen's legs. Excuse me. The opportunities you see will be different to those that I see, for instance. There are a variety of opportunities available. It depends on your perspective. But in all cases, it starts with chart analysis. Look for trend changes. Look for the trend changes on the index behavior. We trade low volatility moves with warrants so we can leverage the returns from those moves. That's the key factor. The key advantage that warrants give us is it is a force multiplier, as they say in the military. In other words, a 5% move can be turned into a 15% move when traded with a warrant and using leverage. It reduces our time in the market exposure by using the warrant to magnify the returns over the short term. The longer we are in this current market, the longer we expose ourselves, 1 week, 2 weeks, 3 weeks, 4 weeks, who knows what President Trump will come up with tomorrow, or in 5 days' time, or in 2 weeks' time. So in that sense, the more time that we spend in the market, the higher the risk of an external event which may completely destroy the foundations for the trade that we've set up. We overcome that risk of time in the market by completing our chart analysis, but when we come to execute the trade, we execute using a warrant so that the returns over a short period are magnified. It's easier to trade warrants over an entire index than individual stocks. It has a different risk structure. We avoid the individual risk of an individual stock by trading the index. So understanding where the Nasdaq is going, understanding where the S&P is going, and trading that via a warrant gives us an exposure to the entire movement, and we're able to magnify the returns that come from it. Remember that Hong Kong stocks are not the same as their Chinese or mainland co-listings. The performance of Hong Kong stocks, the performance of the tech index, is influenced by Western thinking about the markets. Now that can be useful because the American thinking is that the Chinese market is going to collapse under the pressure of sanctions being imposed by and tariffs being imposed by the United States. As we can see, the Chinese market is much less exposed than it used to be and is developing its own strength in alternative markets. So those co-listed stocks that are sitting in Hong Kong can be used to trade that alternative perspective, that alternative outcome. But in all things, we need to remember our size. We are not Warren Buffett. We are small traders faced with massive market changes, as we started off with. The small boy taking on the sumo wrestler. That is what we are doing. To survive in these market conditions, we need to make sure that we trade in ways that are appropriate to our size, that reduce the risk of our market exposure. And as Jamie will discuss later, using a warrant allows you to maximize the returns from your analysis. As you know, we do a weekly newsletter. We will give you 1 month's free access to the newsletter, where we discuss both these strategic issues and specific trading techniques that we are applying as well. Thank you for your time and attention. We'll take questions at the end of today's presentation. Thank you very much.
All right, next up we have Jamie. Jamie, if you're all set to go, I'm going to give you sharing rights so you can show the website you have for us.
Hi everyone, I'm Jamie. I'm the head of Singapore Warrants for Macquarie. Thank you, Daryl, for sharing your perspective on the various indices. What I'm about to show you next is how exactly you can use warrants to potentially magnify the returns based on the views that Daryl has shared. In order to do so, you have to access a website, probably the best warrant website in the world, in my opinion, warrants.com.sg. And over here, I've gone on to the brochure tab to show you exactly what are structured warrants. For those of you who have never heard of it, well, there are essentially two types of warrants, a call warrant as well as a put warrant. A call warrant generally increases in value if the underlying that is tracking increases in the short term, whilst a put warrant moves in the opposite direction. It goes up when the underlying comes down. So whether or not you're bullish in the short term or you're bearish in the short term, there is a warrant for you to trade with that view. Now, why trade warrants though, right? Because there's so many different financial instruments out there that you could be looking at instead. For example, some of you prefer to directly trade the shares. Some of you prefer to directly trade the index futures and other products, so on and so forth. Well, there are essentially three key benefits to trading a warrant. The most popular is leverage. With warrants, there is one that could amplify your returns by 2 times to as much as 30 times. So there are different kinds of magnification degrees when you use a warrant. Something more conservative for those who are starting out, something for those who are very sure that their view could be correct during the next day or during the week, because the market has experienced a big move and they think that a potential rebound or a sharp pullback could happen in the short term. These are the people who are looking to maximize the exposure and would therefore go for something that will move maybe 20 or 30 times more than underlying. At the same time, whilst this is starting to sound very risky, of course, if it can move between 2 to 30 times more than underlying, if you're correct, it could also move in the opposite direction if you're wrong. However, there isn't a minus 300%. As we know, the maximum loss one can lose is 100% in this case with warrants, right? There is no more than 100% loss because it's not a margin product, meaning if you're wrong, you're not about to get your broker calling you up to ask you to top up your margins in order to stay exposed. The maximum you can experience is 100%, which of course is not very little, but because warrants require such low capital outlay as a result of their cost of between 10 to 20 cents, typically less than 10 cents. Therefore, your 100% loss at its maximum is really limited to a very low capital outlay. Sometimes could be less than your unrealized losses in shares. Okay, and with that in mind, if now we think that, hey, this is an instrument that we potentially want to look at because of the key benefits, what is one way you can start, or what is one way you can select a warrant based on the views that Daryl has shared? So we have simplified the selection process for warrants to essentially 4 simple steps. Of course, different people will have different ways of selecting a warrant, but we think that the simplest way to think of it is to first have a view on the underlying. You're using a warrant because you are expecting a big move to happen in the short term, whether or not it's a big bullish move or a sharp pullback, right? But you are having a view that the price of the underlying that you're looking at is about to make a big move in the short term. So therefore, the view you must have would be exactly that view that you think you would want to enter in the underlying, all right? Your entry target level. At the same time, when you enter, you have to learn to exit. So what is your target exit? What is your profit taking level? Right, so these 2 views are important, but just as equally important is your cut loss levels, because as we know, it's not every day that we're going to get our views right? And sometimes our views could be wrong, especially when you look at the charts, when a key support level or key resistance level, if you're short, has been breached, and you probably want to cut loss rather than hang on to a losing position, right? Because your views are wrong in the short term. And so first and foremost, your view on where to enter, where to exit, and where to cut loss on the underlying itself is very important, which is why we've worked with experts such as Daryl to provide that kind of view and perspective on the underlying, because that is first and foremost most important in determining where you're going to enter and exit from the warrant. Now, second, you need to decide on how long your view holds. The reason is, warrants are suited for short-term trading only. They are not meant for you to hold on for a long time and hang on to it and cold storage the warrant if your view was wrong, which I think some of us, are prone to doing when we're wrong. Rather than cut loss, we will just sit on it for as many years as it takes until we break even or make some money. But with warrants, you can't do that because they've got an expiry date, and with all listed leverage products, there's going to be a holding cost, right, known as time decay with warrants. So the longer you hold on to it, the more holding costs and the more time decay you're going to suffer from. So the holding period is very important. Step 3, you need to determine what kind of gearing you're happy to have. Like I said, warrants, one of the benefits that it comes with is the fact that it's able to provide you leverage, provide investors the magnification that they are looking for. So rather than make 1% in the underlying, they could make anything between 2% to 30%, right? So you need to determine what kind of gearing you are suited for, whether you are risk-adverse investor who probably just is happy with a lower gearing level because you're just trying the product, or you're rather seasoned, or you're rather sure with your views. It's a very short-term view that you're having, maybe just this week because you're trading at event risk, and if so, then you want to go for something with higher gearing. And lastly, I think as with any financial instrument, you really should be trading them on tight spreads because that's the most cost effective. So with these 4 steps in mind, we can then select a warrant. Now, if all these 4 steps sounds like a lot, don't worry, we have a tool known as the warrant selector tool to simplify the warrant selection process by taking into account the 4 steps that we've just talked about. So for example, if we were looking at underlying that Daryl has just mentioned, say the Hang Seng Tech, and we wanted to see how the warrants will perform based on, say, a bullish view, we will then select the call. And given that the Hang Seng Tech finished at 5,814 today, if we thought it was a good entry point, we must then have what? An exit level next, right? In this case, the exit level would say maybe 6,400 because Daryl believes that there could be a strong resistance there, of which if it crosses, then we can aspire towards 6,008. But if so, that's a 10% upside from where the market currently is, or at least it closed at 4:30 p.m. today. Now, in order to see what our holding period should be when using either of these 2 warrants, which are quoted here, now there are more than 2 warrants, more than 2 Hang Seng Tech call warrants. But the reason that this table is only showing you 2 is because we've naturally taken into account the fact that if the warrant was on wide spreads, more than 3 ticks wide, we're not going to include this in this table. So this has addressed step 4 of choosing a warrant, which is to select a warrant on tight spreads, right? So we've taken out those on wide spreads and it's been eliminated, and we're down to just these 2 warrants to choose from. So we go back to step 2, which is what your holding period should be. In order to know that, we have to simply increase the number of weeks by pressing the up cursor. And straight away, you will see the simulated returns on these 2 warrants here. And it will tell you exactly what kind of gearing these warrants provide you. Now, bearing in mind our target exit level is 10% higher from here, what this table says is that this warrant, the first call warrant here, is costing you 9.6 cents today when the index is at 5,814. Now, if the index went up by 10.1% in 2 weeks, which is your profit-taking level, this warrant will go up by 58.3%, which is 5.8 times more than the index's gain. This second warrant, which costs 23 cents, will go up by 4.2 times more. So it's gone up by less. Why? Because it has a lower effective gearing. It is a less risky warrant, but what gives? The amount of capital outlay is going to be more because it costs you 23 cents rather than just 9.6 cents. Okay? And to see how long your holding period is, you simply increase the number of weeks. And you notice as I increase the number of weeks, the percentage gains are dropping. Now, why is that? The reason is because of time decay or the holding cost setting in, whereby the longer you hold on to the warrant, the more time decay is going to set in to erode your geared returns. And so as you can see now, earlier when it took just 2 weeks for Hang Seng Tech to reach 10% from here, it generated a return of about 5.8 times more. But now it's generating a return, this same warrant is only generating a return of 3.4 times more, a 34% return. This second warrant, on the other hand, is now generating slightly more returns of 3.6 times more. Okay, and as you increase the holding period, you'll find that the second warrant here is generating more returns. Why? Even though it's got a lower effective gearing at the point where you're buying it. But in this warrant allows you to hold onto it for a longer period, whereas the time decay for the first warrant has set in to erode the effective gearing such that the percentage gains now are lesser with time compared to the second warrant. So with this tool, what you can do is to narrow down your selection, okay, to the point where if you increase the number of weeks, you can then assess which warrant you prefer holding on to. So for example, if you think Hang Seng Tech could make a 10% move easily in 4 weeks, then perhaps you will want to consider the first warrant instead. And while 10% in 4 weeks sounds like a lot, but if you actually look at a lot of these Chinese tech stocks, some of them are moving 10% in a day, right? Today, some of these are down 4%. So, you know, in a day, it's done about half that percentage move. So it's not difficult for the index to move 10% in 4 weeks. In fact, I think it's moved exactly that, right? 10% in 4 weeks over the past 4 weeks. Now, if you play around this tool and you keep increasing the number of weeks, like I said, the holding cost is going to erode into the gearing to the point whereby you find that from the 9th week, this first warrant here is only generating returns 1.5 times more than the underlying. What this means is that the maximum holding period for this first warrant is therefore 9 weeks. Now, if you hold it beyond this 9-week holding period, you'll find that this warrant will now make you less return compared to if you were to buy the Hang Seng Tech futures directly. And therefore, your maximum holding period of this first warrant must be 9 weeks. So that's exactly how you can use this warrant selector tool to select a Hang Seng Tech warrant with your view. And you can repeat this same exercise for the other underlyings. So for example, if we were to look at the Hang Seng Index, right? So again, we're bullish. The kind of target level we can put in is probably, you know, inspired by what Daryl has said, 26,650, which is also around 10% higher from where it closed today on the futures at 4:30 p.m. You increase the number of weeks and you'll find that in this case, there are more warrants because we've got more Hang Seng warrants, okay? And you just keep increasing the number of weeks. And you'll find that by the 6th week, if that was your holding period, you know, you're generally comfortable with something more than a month, about a month and a half. In this case, you'll find that it already eliminates half of the warrants here. Now, if you wanted to be more conservative and you think you want to give it an 8-week period, you find that this first warrant here would now be in the red. So it's going to lose you money even though your view is right because the time decay has eroded its gearing effect. And so you probably want to just choose from these 3 warrants. The selector tool has a maximum holding period of 12 weeks. If you wanted to hold beyond 12 weeks, there is another method of estimating its price return. In this case, let's have a look at this warrant here, VPXW, which will make you 25.8% returns if the index were to go up to 10%. But if you wanted to narrow down to the date, the approximate date you should hold on to this warrant for, you can click into the warrant code. It takes you into this tool called the live matrix, where it tells you live during the day where the warrant is trading alongside the futures, okay? So you can see how it moves live during the day. But now we're after the exact, or rather I would say the approximate date that we should be exiting from this warrant. In that case, you can use the warrant calculator tool, which works very similarly to the selector tool. Enter your exit level of 26,550, and you find that the warrant will increase 8.7 times more than underlying if that happened today. Of course, it's not going to happen today. And if you were to hold it for about 2 months from now, this index is going to go up by about 4.3 times more. But what we're really after is the maximum holding period on this warrant, right? The approximate date we should hold on to this warrant. And earlier it said that in 12 weeks, which is about in 4 months, it's still going to make you some gains. So we just have to increase it further. And you find that by the 3rd of July, okay, a bit more than 4 months, the gain on this warrant is going to be only 13.3% compared to the 10.6% gain in the index futures. What this means is that you really want to exit from this warrant before the 1st week of July. okay, in order to maximize your return via this warrant. Because if you to hold it on for another week, you'll find that the percentage gain on this warrant is now going to dip below that of the underlying. Okay, and so this is how you can use the tool to estimate your holding period, to ascertain the approximate gearing that you're going to get. Of course, you'll find that the shorter you hold on to the warrant, the more gains you're going to make. And that really is why one wants to use a warrant, because they want to be exposed to the market only in the short term, and that they believe that the stock market move that they're after is going to happen in the short term. Now, if you think it's going to take a long time in order for the market to go to 26,650, you probably wouldn't want to consider a warrant. And what do I mean? What do I mean by a long time? If you look at the exercise we've done with the calculator, basically, if you think the market's going to head higher, beyond July, it's going to head higher only 6 months, then you probably wouldn't want to use a warrant in that case to trade that move, especially if you wanted to enter today. Okay, this tool can also be used to estimate what your losses are. So for example, it's great if the Hang Seng went to 26,650, in the next 2 months, and then you can cash out on a 47% return. But what if your view was wrong? What if it went down to the 23,000 support level that Daryl was talking about, and it broke below that? In that case, know that your negative returns, your losses are also going to be amplified, just as it amplifies your gains. So in this case, if you had lost about close to 5% by entering into the futures, you would have lost about 53% via this warrant, okay? So cutting your losses, knowing when to enter and exit is very important. Now, we've just seen an example of how to use a call warrant, but how do we use the put warrant? Okay, because Daryl has talked about rather bearish views in the short term in the US. Now, if you're holding on to US shares, as many people probably are, you're an NVIDIA shareholder, or you've bought into quite a lot of quantum computing shares, which was all the rage before the tariff situation came on, or simply you're holding on to some bellwether US shares, not quite a tech share, but you've been a long time shareholder of the likes of your Intel, your likes of Walmart, etc. What can you do? I think one of the tools that have been underused is really the put, whereby you can use it to either hedge against the short term, because you're in the long term you're bullish, but you just think in the short term there could be some pressure just based on what you see on the charts, or just based on the news that comes out overnight. So for example, we just saw the FOMC last night, and we're worried about that kind of event risk, or just what Trump would say next, and in that case, we can use the put. Why? Because it's going to go up in the short term when underlying comes off. And if you were not keen to exit from your US shares and you just wanted to protect the downside in the short term, what you could consider using is a put warrant, right? And in this case, how can you use a put warrant? How many of those put warrants should you buy? And what kind of hedge returns would you be seeing, in order to cover your losses in your portfolio? Now, we have one tool for you to approximate that, how you can use a put warrant to hedge against your portfolio of shares. It's called the Exposure Simulator tool, found in the Warrant Tools dropdown of warrants.com.sg. Now, if you go on there, what this requires you to do is to know the warrant that you're already keen on, because it doesn't narrow down to the specific warrant that you should be looking at, such as the warrant selector tool, which it tells you how to narrow down your selection to the specific warrant. So you should have already used the selector tool to narrow down your selection before coming here. But let's say you already did that and you were keen on this S&P put warrant MHOW expiring in June, because the only other put warrant that exists is one that expires tomorrow. So you really only have one put warrant, right, to choose from. In that case, what you would do here is that, first of all, you want to note that this index warrant is not going to perfectly hedge your portfolio, because we don't know what your portfolio of shares consists of. But if you wanted to use a broad index put warrant to hedge anyway, because you don't have other means of doing so, you can. And what you would do here is that you change the number of shares owned to reflect the closest value of the portfolio of shares you're currently owning. So for example, if you're holding on to about $115,000 worth of US shares, or maybe we'll round it up to about 150,000 thereabouts, okay? 150,000, okay? So you would just change this so that the underlying portfolio value reflects closest to the portfolio value that you're holding on to. Okay, and what this tells you is if you're considering this put warrant to hedge, in order to hedge this portfolio value of 152,000, you will need to buy $19,000 worth of this put warrant, which translates to about 180,000 units of the warrant. Okay, so I repeat, in order to hedge this portfolio value here, what this tool tells you is that you need to buy 19,000 units of this warrant here, okay, and that would translate into you typing 180,000 units of this warrant, because the warrant costs you about 10.6 cents in order to achieve a warrant value of 19,000. In order to see how this warrant will perform alongside your underlying, okay, you just need to change the share price or the index level to the downside level that you're looking at. In this case, I believe, Daryl, you said that it could potentially go to 5,200 in the short term, which is about 9% lower from where the current S&P market is. Now, if the market were to move 9% lower, or if your portfolio were to take a 9% hit, that would cost you about 13,500, okay? But if you were to use this warrant, this put warrant, because it's going to go up in value when underlying comes off, it's going to go up by about 88% today. And if it took about 19 days, so about 3 weeks in order for the US to come down about 9%, this put warrant will gain 80%. Okay, it will gain 80% from 10.6 cents to 19.1 cents. And how it will translate if you bought 180,000 of it is it's going to make you $15,200 to offset your portfolio loss of 13,500. Now again, with warrants, it's all about finding out what the maximum holding period is. And what you'll find is that as you increase the number of days, this percentage gain is going to drop. But this absolute value is, of course, also going to drop. And you want to simulate to a point whereby, because you're trying to hedge your portfolio, right? You're trying to hedge against your portfolio losses. You probably need to increase it to the point where, okay, there you go, where it tells you the maximum number of days you have to hold on to this warrant before it no longer covers your portfolio loss. In this case, the answer is around 35 days. So holding on to this warrant for about 35 days from now would exactly hedge your portfolio loss in absolute numbers and return. Okay, but in terms of percentage gains, it's going to make you 73% versus a 9% loss. Okay, and if you held on to it for more than 35 days, that's fine. You're still going to make an amplified return of 62% versus 9%. And it's going to keep making you amplified returns. The maximum number of days you can hold on to this warrant is 85. And it's still going to make you 54% versus a 9% loss in the underlying portfolio. But in terms of absolute returns, it's actually going to make you less. It's not going to be enough to cover your absolute loss in your portfolio. Okay, so this tool really introduces a new dimension for those who are looking to hedge or trying to replicate the portfolio. Okay, but of course, if you're simply going to buy this put warrant just to profit from the downside, not to hedge because you're not holding on to US shares, then, well, the good news is that you're going to make 54% return, and that's, that's great because you don't need to hedge your portfolio losses of 9%, and you're really going to make the entire 54% here. And even though the absolute value is just about 10,000, it doesn't matter because you're not looking to hedge against losses. So this will be pure profits only. Okay, so note that this exposure simulator tool does two things for you. It tells you approximately if you're looking to get, an exposure of, this amount, whatever exposure amount you're hoping to get. Oops, sorry. Are you still seeing my screen?
No, Jeremy, I'll give you showing rights. No, you just head down to the bottom of your screen. Beside the camera icon, you can share your screen from there. Ah, great, I see it now.
Okay, yeah. So the exposure simulator does two things. Like I said, it tells you if you were wanting to replicate the exposure of whatever amount you want, the number of units of warrants that you can buy to replicate the exposure, and the amount of money that will cost you, the amount of capital outlay required. And it also tells you, the maximum holding period you should be looking at, the maximum holding period that you're looking at in order to continue to make amplified returns. So if you're looking to hedge, the holding period is typically shorter than if you're buying it purely to profit from downside moves. So in this case, you can hold on to this warrant for 85 days, and if S&P came down 9%, you'll still be making returns of 54%, which is about 5 to 6 times more than the underlying move. Okay, and I hope that was good for you in order to understand how warrants work. I'll probably do a final demonstration with, in this case, a NASDAQ put warrant using the exposure simulator as well. A NASDAQ put, in this case, again, is between a March expiry, which expires tomorrow, or a 20th June expiry. Okay, if you wanted to know further terms on the warrants, for example, what the strike price is, what kind of premium percentage it is, what kind of gearing it has at this point in time, what the last trading date is, it's all available on the warrant terms tab. But for the purpose of today's demonstration, we'll go to exposure simulator, where we really want to see how we can potentially hedge, say, a portfolio of, say, US tech shares that you're holding on to. Again, this NASDAQ put is not going to entirely hedge and perfectly hedge your portfolio of shares, because your portfolio of shares could consist of various, different shares, some of them tech shares, some of them not. But in this case, if you're looking for means to hedge the downside anyway, broadly, especially based on your view on the NASDAQ, right? In this case, you can use the NASDAQ put. It costs you about 11 cents now. If you're holding on to a portfolio of about $130,000 worth of US tech shares, with this warrant, you probably invest just about 21,000 in Sing dollars by buying about 176,000 units of this warrant. And you can just repeat the same exercise, putting your target exit level, because in this case 18,500 is the support level, and we think it could potentially rebound from there. In which case you want to exit, take your profit. You take your profit here, and then if it rebounds, your portfolio value would be less red, and so you wouldn't need a put warrant to hedge it anymore. Now, I think it's important to reiterate that you need and you should exit, based on the holding period that this simulator tells you. So in this case, with the NASDAQ, you find that your holding period is in fact shorter based on this view, with the market down about 7%, in order to have an absolute return of 8,900 to cover the absolute loss in a portfolio. Your holding period is just 12 days. It's important to note that you shouldn't be holding on to it forever, because they are not like your shares. They're not like your futures, where you can roll and continue to stay exposed for years and years. If you were wrong, you really need to cut your losses, because with time, it's going to erode into your returns. And if you held it all the way to expiry, in this case, if you held it to the last trading date, you're still going to make a gain of 14% versus a 7% loss. But if you held it all the way to expiry, what's going to happen is it's a binary outcome. It's either on expiry date you get a value back, a cash settlement amount back, or you get zero. So in this case, if this put warrant, it has a strike price of 2,500, and if the NASDAQ were to go up to 2,500 or even 2,600, right, your view was wrong and you refused to cut your losses, right, because you were seeing amplified losses here, and you wanted to hold on to it. What's going to happen at expiry is, because the index has finished higher than your put strike, you're actually going to get zero back at expiry. You're going to get 100%. You're going to sit on 100% loss. Okay, so it's important that you learn to cut your losses, even though they're amplified. get whatever capital outlay you have back, and then hopefully look for another warrant or another underlying where you can use to with a warrant to amplify your view again and recapture the returns which you might have been read for in this warrant, in this trade, and use whatever remaining capital you have to further amplify your outlay again, and then hopefully have an amplified return that will offset your losses from this trade. Because what we found is that when people refuse to cut their losses and hold it to expiry, you're likely to get 100% loss rather than 81% loss. So just bear that in mind. And with that, I have come to the end of my portion with demonstrating how to use a warrant to capture the kind of price return that you could be looking at based on Daryl's view. But to repeat, you need to have your entry, exit, and your cut loss levels. Perhaps something you can ask Daryl about shortly in the Q&A on what his cut loss levels in order to better, frame your trades in the short term. Shri, I think I would hand it over to you now to answer the final question on if someone were to be keen on trading warrants on the Philip Nova platform, how would they do it?
Yeah, thanks for the handing time over to us. Next up is my colleague Tae E Kai from the Philip Nova Client Relations team. He's going to give us a very, very, very quick platform walkthrough of the Philip Nova 2.0 platform. E Kai, if you're all set to go, I'm going to make you a presenter right now.
Hi guys, I'm Mikai here. So I'm from Philip Nova Client Relation teams. Can you guys see my share screen right now?
No, I don't see it yet. Just give it a few moments. Do you have a
Okay,
prompt pop up on the screen to share your screen?
okay, how about now? Okay, maybe I'll just reshare the screen again.
Yes, yes. Thank you so much.
Okay, are you guys able to
Yep.
see now?
Yep, I see now. Over to you,
Okay,
Kai.
good. Okay, so these are our trading platforms. Once you log into our trading platform, right, this is the page that you will be you will be looking at. So you can just simply select this simple page. Then this is a list of your watch list, and I have this warrant watch list here. So how are you going to add structured warrant contracts, right? You can just right click at the watch list, and there's a add symbols here. So you can just select it. Then you will see several product types here. You have futures, spread, option stocks, and you will see structured warrants at the last one. So you can just select this and then you can go to Singapore Stock Exchanges, select it. So how are you going to select Macquarie Bank's structured warrants, right? You can just type in MB for the keyword. So you can see from here, there are like several contract, we have MB inside, right? So how are you going to interpret it is, you can read the underlying assets. So the word beside the underlying asset, right, is if there's an MB here, that means this is the contract that is issued by Macquarie banks. So let me select a few of them. So this one, HGX, Hang Seng Index, and maybe Singtel as well. Yep. So this is how you can add the contracts into the watch list. And how are you going to read this contracts names, right, is the first word you can see is the underlying assets, and the right one is the issuer, which is Macquarie Bank, and the E itself is actually representing the European style, which the contract will only can only be exercised upon expirations, and the C itself is called warrant, and the numbers behind is actually representing the expiry dates of these contracts. So how are you going to place order, right? Is you can just right click at this contract itself and then place order. then you can just key in the quantity that you want to buy. So for example, one lot size actually equivalents to hundreds quantities. So once you key in hundreds, and yep, this is the price. So you can just key in limit order. So limit order means that you want to buy this contract at this specific price. So for example, for this limit price is 0.004. So the total order size, right, you can just take 0.004 times 100. So it will be equivalent to 0.40. So which is 40 cents of Singapore dollar. Yep. So yeah, basically that's it.
Going to the questions right now, we have a question from Motley Crew. It's on gold. Daryl, I'm not sure if you want to take it. The question is this, Daryl. Okay, Daryl, gold is not suitable for global trade transactions, and countries that export commodities do not establish their own exchanges to trade these commodities using their domestic currencies. Is there an alternative for the petrodollar? Daryl, do you want to give your thoughts on this, or maybe you can direct us to what you share about the outlook today? Hi, Daryl. Did you hear the question?
No, I didn't hear the question, sorry.
No worries. Okay, so we have a question from Motley Crew. He's saying that gold is not suitable for global trade transactions, and countries that export commodities do not establish their own exchanges to trade these commodities using their domestic currency. Is there an alternative for the petrodollar?
Is there an alternative for the petrodollar? Well, many people think the alternative is gold, which of course is why the price is going up. Belt and Road Initiative, the BRICS countries are trying to establish an alternative trade settlement system, which is opposed by the United States, of course. And President Trump has made all sorts of threats against anyone who dares to use that approach. But the development of the Chinese digital currency, which has been taking place over several years, the idea of a BRICS common currency, they are the alternatives that that nations are exploring for cross-border transactions and cross-border trade settlement at the moment.
All right, thank you so much, Daryl. Maybe you can just to wrap this up. Maybe you can share with us the top three takeaways for today, and we can end the session proper.
Okay, well, the top three takeaways. The first takeaway is that time in the market has become an increasingly large risk. There are times when you trade, to use the term, when you're trading, where you can reasonably take a long-term position, spread over weeks or months or years, and be relatively confident it's going to develop as you anticipate. The turmoil that sits within the American environment and the way that's spreading to the global environment means that the longer you have an open position, the higher the risk is that that position will not develop as you expect or turn against you. The second takeaway is that your analysis is always done on the underlying chart. That's where you make the decision about whether it is appropriate to enter and what your upside target or downside target is as well. That's done through standard chart analysis. But what happens is that you choose to do the execution of the trade using the warrant. The warrant gives you an advantage in any normal circumstance. As Jamie has said, it allows you to magnify the potential profit that comes out of it. But in this particular instance, it means that you can generate a good return in a shorter time frame. The third and final key point to remember, I suppose, is that you need to trade your size. We're not Warren Buffett. We can't afford to hold on to a position. And as Jamie pointed out, particularly with warrants, the impact of time decay means that either it moves in your favor or it doesn't. And if it doesn't, you cut your loss, and you cut your loss quickly. But in any situation, we need to recognize that we are not able to control the market. We are not able to outguess the market. We're not able to outthink the market. What determines our success or failure is how we manage the open positions that we take. I think they're the top three that I would say that comes out of this evening.
All right, thank you so much, Daryl. Before we wrap up, Jamie, do you have a few words to add for the audience today?
Well, I would say that, these are very volatile times. We can see, day in and out, the markets are no longer just finishing unchanged. Even if it does, it would have made a big up and then down. And we've been seeing that all of this year so far. And I believe, we are all priming ourselves for more volatility ahead. And I think it is then time for investors who previously were only used to buying and holding onto positions for a long time to really learn a new instrument. It could be warrants, it could be something else, but in the case of our session today, we've thought about warrants, and it is our hope that you can use it to our advantage. To your advantage, I meant. And really, I mean, for us as a warrant issuer, we are in the business of selling warrants. We want you to buy warrants, but more importantly, we want you to buy and make money from warrants so that you can keep coming back and trading these warrants, right? So it's actually in our interest for you to not end up with those magnified losses or 100% loss. So just remember, always have your entry exit cut loss levels ready. And even though it can be very painful, I personally know it's very painful. I have a problem with just cutting my losses, especially if it's down 50%, it's a lot. But bearing in mind that with warrants, it's only a small capital outlay. So a 50% loss sometimes is often less than unrealized, like an unrealized 15% loss in stock. So with warrants, if you wanted to use short-term instruments to really maximize your return, especially when your view is right in this market, you must first of all be disciplined to also take your losses when your view is wrong or when the charts just go the other way, opposite of what you think and where you think it's going. Daryl's provided some views, but of course, if he could fully predict the market, he wouldn't just be sitting here and talking through his views with us all. He'll just be, buying and selling shares day in and out, right? So it's just his perspective. Also form your own opinion of those levels, and more importantly, when the levels get hit, learn to enter and exit. And then hopefully you can make magnified returns with this product that's going to require only a very small capital outlay, and hopefully it doesn't jeopardize, the cash holdings or the cash you need for other purposes.
But Jamie, I would have to cut in there and say what I talked about tonight is the foundation for my trading approach at the moment. So that determines what I trade, and we're trading warrants at this point in time, determines how I trade, we're trading short term, and determines the techniques that I use in this particular lot of trading. So in the last 48 hours, we've taken 30% return out of a single trade in the market. And we'll do that probably again next week, once or twice. So that is our response to the current market condition. As that condition changes, we will change the way that we approach the market and the instruments we use, how long they are open for, etc.
That's right. So good luck to us all. Good luck to you. Thanks for tuning in tonight, and all the best in the markets.
All right, thank you so much, Daryl. Thank you so much, Jamie. And thank you for tuning in. And that's all the time we have for tonight. Keep your questions coming. We have a survey form at the end of this webinar. If you have more questions, you can send them our way, and I'll reach out to our speakers to get their views on that as well. All right, that's all the time we have. See you in the next webinar. Good night, and all the very best for your trading for the rest of the week. Bye-bye.